Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to go through our favorite, the Primary Vision Frac Spread Count, but we're also going to touch on what happened with the OPEC meeting and then what does this mean for the Frac Spread Count and oil going forward, given that we have some bifurcating views in terms of where things could actually shake out. But there's going to be a lot to talk about. Now that we've covered all those bases, now we can really get into, well, what happened this week? Well, we had an increase of 25, which puts us back to about 165. So you might think, well, it should be a little bit higher. Maybe there's timing delays, and that's really what this comes down to, where we still had a small residual from the Texas blackout and the freeze off, with about, say, 3% still impacted. So, but for the most part, we're starting to get back to normal, and we're going to springboard past this now that everyone has seen what's happened with OPEC. We're past another month of uncertainty, and now we can really get back to work. So that, where is this going to really kind of come into play? And it's really just going to continue to be Texas. Texas is the one that's going to continue to see a lot of love, just given its location. You know, obviously refining is there, and we'll talk about where refiners sit in a few minutes. But this is where we're going to continue to see some activity. And just to be clear, we normally see an acceleration as we go through March, and then that acceleration on a seasonal level really continues into the beginning of summer, just given where things are and just, the spring thaw, easier to do things, easier to move around. So that will always, really kind of protect and help us move forward. The bigger problem that we're going to find, and for those that follow us on Twitter, we've been talking about, there is going to be a horsepower problem, a employee problem, because we're going to need people to do this. And how many times can you be let go or furloughed over the last 7 years and willingly come back without some sort of incentive? So this is why we think there's going to start to be some pricing pressure, especially as we start getting into that 200 level, because you're going to have to start taking stuff that's in cold storage. Maybe some of it is still warm stacked, but you're talking about, taking cold stacked equipment, making sure it's up and running. And that horsepower is going to, that's where we're going to start to see some of that tightness as we start to approach over 200 and getting into that 230 to 250 range. So to kind of put it into perspective, where we are, you can kind of see that quick snap back as we start to see this continued climb, which will maintain as we come after the OPEC meeting. And then when you look at where we were at the beginning of last year, so say we had about 350 spreads, but as this equipment goes into the yard and you try to save cost, as we sat at this, sub 100 level for multiple months, you're going to try to manage, you're going to try to do what you can. You had to furlough employees. Like, how many of them found other jobs in trucking or manufacturing or something else, and they're not willing to come back? That's why there's going to continue to be a grind higher. But as we start getting into that 200 level on our way to 250, there's going to have to be a decision. E&Ps are going to have to say, look, I get it. You have to go buy equipment. You have to go buy different things. You have to, I'll give you incentives for stage completions. I'll give you some sort of kicker to make sure that this is available on the other side, or I'll give you a 6-month contract or a year contract just to make sure that this is available when the time comes, because we're starting to get towards that. And I'm not saying it's happening yet, because it's not. It's just these conversations are starting to come up as we approach some of this tightness. And here's that zoomed in look as to where we are in relation. So 161, the 175 to 161 was where we were starting to see guys experience some of those freeze-offs. The colds started before the blackouts and all of that. So there was that impact, and then obviously you had the acceleration to the downside. You had that quick snapback, and now we're back above where we were at that 161 and approaching, and realistically, based on where we are next week, when we look at crude pricing, we look at conversations on the ground, we will be right back around that 175, probably even a little bit above it as we look at the rest of Texas, because the Permian has seen a pretty strong snapback. The Delaware will continue, and then it's going to be a matter of the Eagle Ford and in other parts of the lower, the southern part of the U.S. And this is, I think, an important chart to consider. Okay, well, what did OPEC do? Well, let's look at the curve. The curve is now shifted well above that, straight through till 2032. You can see that curve is between that 50 and 55 level. So you can hedge above 60 through all of 2021 at this point, and then you can get all the way through 2022 at above 55. So not saying that you have to, or that some people might be able to. And there's that difference between private company and public company, because right now there is a competing nature of, well, public companies, they have to cut. They need to make sure to protect the balance sheet. They have to report obviously with to shareholders. But private companies don't have the same type of restrictions. They don't have the same type of hurdles to go through, especially if they're making money. And that's what we're going to look at, because they might, obviously the private guys could be a little bit smaller, a bit more flexible when you're looking at pricing, getting in, getting out of some of the hedging, moving some of these barrels around, taking advantage. So this is going to be something to watch, but it's important to see that on a curve level, we've continued to shift the whole curve up and to the right, which is really going to support activity as we go through, really over the next 6 months. Now, with that being said, it's not like we're going to go from 10.9 million to 11.9 million. We just don't have that capacity. We don't have that capacity in general. But if we really get to 230, 250 spreads, which is very doable, and just speaking in terms of where the prices are, that could really see us at about 11.3, 11.4 million. But to get to 12, we're going to have to get right through there, and something closer to that 300 to 350 level. So it's going to be that movement of a steady pace, which is going to put us at a potential growth, but again, that muted growth just based on where we sit. So when you think about what Saudi Arabia said, where the drill baby drill is over, it's right and wrong, because yes, it's going to be very difficult to get to 13.1 million, and to be very clear, we really outpaced our demand. Like, there was no way that somebody was going to want that kind of crude. We saw prices come down on the physical side well before the paper market, and that was where we started to see some of this movement. So yes, we're not going to see this blind movement into just completing everything that we have. It's going to be a more measured move, but we will start to see some growth come back into our market. And it's going to be driven off of some of the DUC inventory. So the one thing that's important to appreciate is that on a DUC level, we've gone through a lot of our inventory in the Eagle Ford and in the Bakken. On a national level, you can see that we've come down, and the reason why it's not lower is just because of the Permian. There's still a lot of running room left in the Permian. Now, running room is relative, because there were DUCs that were sitting there that made no sense at 40, but make sense at 60. So now you're starting to open up the amount of inventory that is viable at this price deck, especially when you think about the liquids. Think about condensate, you think about NGLs, how it's now supportive of pricing. So some of this Permian, especially in the Delaware, which is lighter, has a lighter oil, would have a bit more viability. So this is why the Permian is going to continue to be a driver. But the limited amount of DUC inventory in the Eagle Ford and Bakken, and then obviously some other areas, is going to require a increase in rig activity, because the completion crews have been outpacing a lot of the rig activity, just because we did have this inventory to work through. And now that we're starting to get to the other side, this is where we're going to start to see rigs accelerate and those completion crews go up. But the rigs start to have to really get back to work when we start looking at the Bakken and the Eagle Ford, but more specifically the Eagle Ford at this point. And well, what does that mean? Who's going to get back to work? And that's why when we look at private producers versus public operators, I think it's important to see the share of private oil rigs by basin. And this is as of the end of January. And you can see that there is still a large amount of individuals who are operating in the Midland, in Delaware, Eagle Ford, and Haynesville for the most part. So the Bakken has pretty much been locked down. That's one where we need to see some activity because otherwise the declines will continue. We have to get closer to about 15 to 20, and we're working towards that. And there's always a seasonality just because North Dakota, obviously it's cold. So this is where they're going to have to adjust. And just to be clear, frac spreads can operate in the cold. It's just they have to be built for it. I mean, if you're in Texas, you're not putting tracers and using heaters and all other types of things, because let's be fair, we drill and complete in the Arctic Circle. It's not like we don't have the capacity or know how to do it. It's just, why am I going to expend that kind of money to be in West Texas? You're not. So that's why those things, just to preface that. But it's obviously cheaper to operate in the summer and in the those types of conditions. So that's where, as we go through March and into April, we should see the Bakken increase. And that's something where, when we look at what the rigs are doing, we expect to see some of these privates pick up, some spare, but also the public side, especially if you see the pricing hedges are now available, then you can start to protect some of your cash flow. And I thought this was another good chart that Bloomberg had, looking at the amount of production that's being driven by family-backed companies, private equity, and they're producing about 25 to 35% of U.S. shale. Now, that's something that has been fairly stable since about 2018. Obviously came up to 19, but it really, there's a lot of stability in those numbers, and especially as we start to get to some pricing power at this point, and then some protection on the downside, we should start to see that grow towards the upper end of the 35% going forward. But, some of the things that we said on the EIA show, I was expecting to see a little bit more reaction on the refining side, but things have been a little bit slow. There were some delays on some restarts. They tried to restart. They had some errors. They had some pressure issues, so they had to come back down. So here you can see that we still have a very elevated amount of outages in the world, but obviously most of it is driven by the U.S., with the U.S. having still about 3 million barrels a day offline. Now, we should see this come down another 500 or so through the weekend. So when we get into next week's EIA's number, we will see, obviously last week was ugly, but we will start to see that come back, but it's going to be very slow. So this will result in, just because if we have production back, we still have exports that are struggling, and we still have a downtime on the refining side. So we will see some builds on the crude, just given some of these backdrops on just that demand level. But now when we turn to OPEC, because OPEC is obviously going to be a big part of the conversation, here's where the official table that came out, and now we turn to April. So what happened? Saudi Arabia and the other nations agreed to roll over the cuts that they had for March, but Saudi also said that they were going to maintain their 1 million barrel a day voluntary cut. So there was a lot of expectations that there was going to be an increase of about 500,000 to 750,000 barrels a day. Part of that being the voluntary cuts starting to go away, and then just the natural increase. Instead, we got an increase of 150,000 barrels a day, with 130,000 going to Russia, 20,000 going to Kazakhstan. Now, that's one piece. Libya is not included in these numbers, and Libya has also increased by 100,000 barrels. Libya is now producing at 1.3 million, which means that 1.2 million barrels a day going into the market that we've been seeing is going to be protected. So there is going to be that component that's going to have to roll in to those April numbers. But realistically, we're not seeing a huge jump. So when we look at Feb through April, you can see that, in February, this is including at the very bottom that 33.98, and we're going to go to about 34.2. So obviously add in 100,000 barrels just from Libya, and you get where the additions are in general. Now, Saudi Arabia also said that when they start to take away that 1 million barrel a day cut, it's going to be over the course of several months. They won't just throw it into the market. Now, these are all positives in terms of what is happening. And you can take this from two perspectives. You can take it from one, they want to continue to draw down that storage, including their own, and I'll talk about that in a minute, and they want to keep that coming down, or they are preparing for a very big turnaround season that's expected in China and other parts of Asia, and putting too much crude on the market ahead of this turnaround period would then put crude back into storage, and they want to avoid that. So there's two different sides where both of them are fairly supportive. It's just, are they trying to go and get in front of additional demand declines, or are they just, do they really want to see this come down? And we're going to have to look at that over time, over the next few weeks, to see really what strategy is working best and where do we sit. Because when we look at the exports, even though Saudi Arabia cut by 1 million barrels a day, and if you remember when we talked about the first half of February, they were actually over their January production exports by 500,000 barrels a day. That has since declined, and they closed that February only down 38,000 barrels a day versus January. So clearly, they cut 1 million barrels a day of production, but they only declined 38,000 barrels a day in exports. So this was a mixture of pulling from their own local storage, but also reflecting that there has been less demand internally in terms of refiners and just in general activity internally here. So you can see on just the general output has been fairly stable. But then when we look at India and China, we saw a fairly big decline going into both of those countries. Now, when we look at overall, it's still fairly flat, but the reason why there's less going there is India did buy a lot, or was buying a decent amount from West Africa. We had China buying more from the North Sea. That has started to abate. And now when we start looking at the physical market, we're seeing some pressure, especially when we look at Angola, which is still struggling to sell March cargoes. April has picked back up, but we'll most likely see March cargoes slip into April, which will then increase their loadings there. Nigeria remains heavy, and then the Congo as well. So UNIPEC was a reseller, as we've been saying, of Angolan cargoes. They picked up one spot from the Congo that probably crossed at a fairly sizable discount, because so far Urals CPC still remain at a discount. But regardless, this is what we're going to continue to watch, is production versus exports, to see where is that movement on those storage levels. But it's also important to appreciate where we sit in the inflation cycle, because when we look at crude pricing, the gasoline prices, diesel prices off of the last incremental barrel. So for us, that's going to be Brent. That's going to be coming in from the import market, because that's the most expensive barrel. So when we look at just the changes that we've seen, this is the one on the left is looking at gasoline. February 15th, we were at $2.50. As of March 1st, we were at $2.71. 21 cents. Again, we're not huge, but we have to appreciate where this is going and what the trajectory is. And I think the Gas Buddy guys have done a very good job of really highlighting of, look, they're now, based on what we've seen with OPEC, based on what we're seeing with the physical market, with the paper market, you're really going to start to see this move up, and we will likely get to about $3 a gallon for regular as we get towards the summer months. Because remember, summer blends are inherently more expensive to make than winter blends. You have to you can't use the same amount of benzene. You have to adjust the for in order to get through the atmosphere. And I won't go through the Reid vapor pressures, but just in general, these are things that have to be managed. And then when we look at diesel, now diesel is more important when we're thinking about manufacturing, shipments to your home. As even though gasoline has continued to stay, with only about a 21 cents increase, you can see that there's been a pretty much a 20 a year ago 28 cents on gasoline, a year ago on diesel 22 cents. So we're moving in lockstep, and this is going to be that pressure. And when we think about people getting back active, getting back to driving and getting out there, we have to consider of what is that going to mean on a demand level. And just to put it into perspective, when we think about, well, what is the price of gasoline? What is the price of diesel, and why does it cost what it costs? I always love this chart. I think it's a good graphic. And you can see crude oil pricing obviously makes up over half of the impacts to gasoline, a little under half for the diesel side. But this is going to be an important metric, because obviously crude prices remain the largest impact. And that's why we talk about crude pricing and what does that mean? Because refiners are trying to catch an arbitrage. They're trying to buy feedstock and then they sell the end stock. And they're just trying to make a margin in between, as we keep talking about margin pressure that keeps coming into the market with the feedstock going up and demand still not getting to where it needs to be. But they're just trying to pass through and collect something in the middle. And that's why they're going to try to pass through crude, but also corn pricing going to the moon is going to be very difficult from the ethanol side. So somebody on Twitter reminded me to, Jason reminded me to look at what happened, the new numbers from the UN Food and Agriculture World Food Price, and you can see that we're back to highs that we haven't seen since the early 2010s. And just given what we've been talking about, what we're seeing, this is not going to stop. It's going to continue to push higher over the coming months, just given where we sit on just the demand levels in general. Now, taking the inflation from gasoline, the inflation from food, then we have to look at, well, what's happening on the workplace. And here you can see that we're back to highs that we haven't seen since March 20th of 2020, as we start to see a bit more activity on that workplace movement. Now, people I talk to, that the data that we've shown time and time again is there's going to become more and more of that flexible schedule, work from home capacity, but it doesn't mean that we can't get some of this coming back as places reopen. People look to get out of the house and get back into an office. So you can see that workplace average has started to move higher. And this is one that we do look at every single week on the EIA show, specifically in segment 2. But as we talk about all these different things, we have to remember the payroll factors, because jobs still remain a problem. Now, clearly the February numbers came in better than expected. They were expected to be at 200, came in at 379. But while it's a positive move, we have to consider, where was this addition really coming from? And is it what are we going to see on the back end? Are these people that are really buying a lot of goods and going to help drive that market? And that's when we turn to the U.S. contributions to headline payroll. And you can see leisure and hospitality was the lion's share. It had the big drop in December. That was that big negative number. And a portion of that came back in February. Now, as things reopen, as restaurants get back in action, we're going to continue to see that side of the payroll get better in March. So the March numbers will continue to see the movement. The problem is a lot of these other areas still remain, have a lot of slack left, and we don't see a lot of that closing. And in next week's Econ show, we're going to break that out into different pieces to understand, while this is a positive, we still have to think about, okay, well, where were we and where are we going? And that's when we turn to the change in payrolls from February 2020. So you can see that the leisure and hospitality, as we were saying, it reversed what it dropped as we went through December. And we're right back, still a little bit below where we started, but getting there. But a lot of these other, the overall component, retail goods, government, still fairly flat. And that's where we want to see some of those movements higher, because there's better money in some of these assets and some of these jobs, which is why when we look at the average weekly hours, we actually had a pretty big drop, because even though people came back, they weren't hired full-time, they were hired part-time. And again, this comes full circle to what we keep talking about with wage compression and what's going to happen on the spending side, especially as inflation continues to tick higher from a food perspective, prices paid level, and then all the way down into the gasoline and just consumption. And that's where we look at, just what is happening in the world today. The ASEAN 10, I did an article that came out today looking at Biden review, China, and then why is the ASEAN 10 and those Asian nations so important for the U.S. going forward. And it's just important to see just how the 10-year yields are back moving with the U.S. And as we continue to shift higher, as we price in, a bit more activity on the economic side, as that normalizes, as we price in more inflation, the 10-year is going to continue to push higher. And that's now pulling up a lot of these other countries, which is going to make their borrowing more expensive. And in our report that came out today, I highlight why that is an issue for countries, specifically India was the focus, the focal point, just because they do have a rising deficit and they're going to have to go out there and borrow. So we also covered a lot of that in the Econ show in the last segment. So check it out and let me know what you think. So I know we covered a lot. There was a lot of ground with the OPEC, commentary and just what's been happening in the world in general. So hopefully this is helpful. Let us know what you think. We love to hear comments, suggestions. Like it, share it, please. Your support is always appreciated. And as always, have a great weekend. Again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.